Good afternoon, everyone, and welcome to the very first Clarion Market and Economic Update webinar. For those of you who don't know me, my name is Sam Petts, member of the Clarion Investment Committee, and I'm delighted to welcome Toby Ricketts, CEO of Margetts and also senior member of the Investment Committee, to the webinar this afternoon. Toby's going to be running through a series of slides to give you an update on where we feel things stand currently in the world. They've sent in a number of questions which we'll hopefully answer throughout the presentation, and we'll also have some more to answer at the end of the update anyway. So we'll hopefully run through this in about sort of 30 or 40 minutes. Over to you, Toby.
When we look at world markets, there's always a whole myriad of ideas and economic data and surveys that we can draw on really to get an understanding of where markets are and where they might go in the future. But something that we've always felt is that when we look at explanations as to why things have happened in the past, usually from that myriad of data, it's only one or two things that really turn out to drive markets either higher or lower. And so we thought that when we're trying to explain to ourselves and to our clients where markets are likely to go, that the more we can simplify that outlook, the more likely it is to be accurate. So in preparing the slideshow today, what I've tried to do is take what we think are the fundamental drivers of market prices and movements, both in recent history and then extrapolating to how that might develop going forward. So just a couple of notices. One thing I am obliged to say is that nothing in this presentation is intended as advice. That's something that is important from a regulatory perspective. Of course, when you meet with your independent advisors, they'll provide advice to you. But what we're trying to do here is give a general overview of markets in the context of a wider presentation. So just put my first slide on the screen. The picture here comes from Lawrence of Arabia, and it's a famous film. And you may have noticed that whenever you watch a film, often at the start, there are these big establishment shots. And those shots are really designed to give the audience an idea of where the film's set and the sort of characters involved, and sort of a feeling of how the film's going to develop. And Lawrence of Arabia was voted as having the best establishment shots of any film. And these shots were there to sort of illustrate the expanse of the desert and how insignificant individual people were within that environment. So I thought that would be a good intro to really talk about markets, what we feel about capital markets and what they're there to do, and sometimes really what they're not there to do. So capital markets have a really important purpose, which is why they've been around for so long and so successful. And essentially the job of a capital market is to provide a facility where people who have savings, which they don't need at the moment, can invest those savings with entrepreneurs who then want to provide services and employ people and create a profit, which they share or should be shared with everybody involved. And this way, people who have savings today that they don't need to spend can realize those savings in the future with a higher value. In the meantime, economic growth is being achieved through entrepreneurs building businesses and employing people. And fundamentally, that's what capital markets are there to do. The word credit comes from the word credo, which is derived from Greece, actually, and it simply means I trust. And so when we invest our money into any asset, there's clearly a significant amount of trust involved in making that decision. And generally speaking, when trust is high, the cost of credit is quite low. And when trust is eroded, if we're lending money to people we don't really trust, we're either not going to do it at all, or you're going to demand a much higher return or rate of interest. A couple of observations about markets: they generally fall faster than they rise, and this really it links back to that term credit related to trust. And it's because as we build trust in an idea, it tends to happen quite slowly. But when we feel disappointed, when we lose trust, it's more linked to a flight response. And so when concern builds in markets, it tends to build very quickly. And we've seen a real example of that very recently, where there was a sense that Russia would never launch an attack on the Ukraine, and there was some trust around things that Russia had said it would do in the past and agreements reached with the Ukraine. And when that trust was broken, we saw how the value of assets changed detrimentally very quickly, particularly Russian assets. So when we look back at markets, you'll see long periods of market rises, but when markets fall, those falls tend to be more dramatic. In the end, markets do always rise. We believe that, and that's because the human condition is always looking to find better ways of doing things, newer ways of doing things, and building businesses to provide and meet those services and those demands, and in doing so, return capital back into the markets. And therefore, as provided that the human race continues to evolve, it is very likely that overall, especially in the longer term, markets will continue to rise. But one of the problems we have is really the perception of time, because when we're in an event, it feels like a very long time. But when we look back on events, they feel as if they occurred very quickly. The example I use for this is watching my children grow up. When they were young, it felt like they'd be young forever. And now that they've grown up, I look back on their younger years and it seemed to have passed very quickly. And we see that from an investment point of view. We look back on markets and we see the point I made, generally they've risen in value and benefited investors. But when we're in a period of volatility, as we are at the moment, the perception of time slows down and it feels a far longer period than it really is. The pursuit of investment returns is really all about wisdom. We're in the information age, so we can find out seemingly information about anything, huge amounts of data available to anybody now free of charge. But it's really taking information and turning that into knowledge, and from knowledge, understanding what wise decisions become is really the challenge. And we've certainly seen more recently that the level of information has made it harder to really identify the pieces of information that are very important to making good decisions. And the final thing I'll say about markets is there is no such thing really as a market. It's just a group of people. So a market represents a group of people who are trading with each other to try and identify what fair value is for all of those assets. And markets, just like people, can get carried away, can get pessimistic. And so we do see misallocations of capital from time to time, and falls in markets which are short-term and recover. And it just reflects the general nature of people and their strengths and sometimes their frailties. So just a bit about markets. In terms of the way we think about markets, we think it's really important to analyze the data and then think independently. Something you do see within markets quite a bit is people can get quite attached to a herd view, and there's almost a sense of if there's enough people who have the same view as you, it feels quite safe. And sometimes it can be quite safe, but we think it's really important to have independent thoughts. And the way I'd outline this as an example is when you're learning to fly aircrafts, one of the lessons that you have to undergo is they put you in a training aircraft and blindfold you, and they put you through all sorts of spins and loops and steep climbs and descents. And then after a period of time, they ask you what you think the aircraft is doing, and your reaction is that the aircraft is just flying straight and level. And at that point, you have to take your blindfold off, and you're greeted with this picture, which is actually that the plane is in a spiral dive to the ground, and it needs to be corrected, otherwise it will crash. And what the instructors are teaching you there is that if you rely on your senses, once you're in a spin for long enough, actually it feels quite normal, and you start to think the plane is fine, flying straight and level. But actually you're in danger. And so the lesson is you always rely on the instruments, always read the data and make independent assessments based on that information, not on your feelings. And we think that really applies to markets, because we have seen periods during technology bubbles, I suppose quite recently, or railway stocks, or even tulip bulls, when enough people believe in something, it can become accepted wisdom that it's a good asset. I suppose cryptocurrency, even as we speak, could be a good example of that. So just turning on to where markets are at the moment, actually, up till very recently, we've had a very good period for investors. And this strong decade plus, as I've described it, really began with the global financial crisis. So as I'm sure many of you will remember, there was a bit of early warning of a global financial crisis in 2007 when Northern Rock in the UK failed. Initially, it was considered that may be a one-off, but as the dominoes began to fall, it became clear that there was a systemic problem with the global financial system. And banks had essentially overlent to people they trusted too much, given credit where they shouldn't have done, and now these assets were unlikely to come back. And therefore, banks faced quite a big hole in their balance sheets. And that was going to have serious repercussions for the whole global economy, and could have led to a serious recession and into a depression. But because central banks had seen what happened in the late 20s, which was the last time there'd been a serious failure in the banking sector, the response was completely different this time. Interest rates fell, the cost of capital reduced, governments started pushing lots of money into the financial system. This quantitative easing was the term that we heard, by which governments printed money, essentially pushed it into the bond markets. And that carried a tailwind for investors for quite a long time, because as capital gets cheaper and cheaper, it finds its way to global markets and pushes up assets. This was exacerbated at the end of that trend by COVID-19, where we saw central banks move even further than they had already, pushing interest rates even lower, a massive acceleration from a lot of QE to an extraordinary amount of quantitative easing. And in total, we saw the world print about $20 trillion. So I've just got a message. Let me just restart my my screen sharing. I'm not quite sure why that stopped. Just bear with me. Okay, that should have come back up. Are you nodding, Sam? Has that come back up?
That's all fine.
Okay.
Yeah, crack on. Yeah,
Okay.
thank you.
Thank you. And so further interest rate reductions, acceleration of QE, and in total, the world printed $20 trillion, which is about 25% of the annual output of the whole global economy. And what I've illustrated that with is a ship sailing with the wind behind it. So it's when the wind's behind a vessel, it's quite easy to make good way, because if you put any sail up at all, and the more you put up, the better, the wind just pushes things forward. And actually the boat moves forward in quite a calm way, because with the wind behind, the boat's fairly stable on the water. And that's what we've really seen for the last decade plus, is the benefit of this very relaxed approach to monetary policy. And if I just put that into some graphs, so I've taken the 1st of January 2009 as really when the global financial crisis occurred. And what you'll see really is these are the major markets: America, Asia, UK, Europe, and Japan. They've all done quite well. And in fact, any periods of market falls have been fairly short-lived. So it's been a period where it's been unusual for investors to be down value even from one year to another, which a year is really quite a short period of time in investment terms. And overall returns have been very good. Now, if we look at sort of the pack, they've all delivered 200 to 300% returns. Japan's a bit on the low side. But the standout performer for the last 12 years or so has been the US market, which has nearly doubled Asia Pacific and given what is quite an incredible return of 500%. Now, that's quite surprising, because all of the companies in these markets really operate in a global economy. So they're sensitive to changes in global economic condition. So for one market to outperform the other so significantly is a bit unusual. But the US is one of those very entrepreneurial markets. They tend to have a high risk attitude. It's a market that encourages innovation. And so when there's a lot of cheap capital out there, the US market is one of those markets that really sort of sucks up that capital and puts it to work, sometimes effectively, sometimes not quite effectively. And we saw in the tech bubble in the late 1990s an example of where there was a lot of exuberance, particularly in the US market. But certainly all markets have done well, and the US has really stood out. A big key really to where markets have been and where they're going is what's been happening with inflation. So I've just taken the same period and put the UK measure of inflation. The key measure is the CPI. And I've put two lines on there just to give you some context. So the green line is what inflation would have done at 2%, which is the Bank of England's target. And the red line is at 2.5%, which is more or less what inflation has averaged over this 12-year period. But whichever way you look at it, inflation has been on the low side, and there hasn't been really any significant periods of rampant or high inflation up until very recently. And so one of those things that's allowed central banks to keep that tailwind for markets is that as they've been pushing interest rates lower and lower and printing more and more money, the fear that they would have had that might lead to inflation hasn't occurred, or not until now. So it's been a decade really of very, very low inflation, coupled with very loose monetary, very loose money supply. And as we saw on the charts, it's been a very good environment for investors. What's happening at the moment, though, and what's leading to the volatility we've seen in markets, is that the inflation outlook is really changing. One of the things that's kept inflation low has been globalization. We've seen up until very recently that the world has found more peaceful means to coexist and worked proactively economically to trade more and more with economies with each other. And one of the great effects of global trade is it reduces the price of goods. So something we might all be able to recognize is white goods, as we call them, things like washing machines and fridges, have been in permanent deflation virtually forever because of low cost production from China through the 90s and into the noughties. But we really changed the inflation picture through COVID. So gradually over this process of a decade, the bases for higher inflation have been loaded by so much money being pushed into the global economy. And then in COVID, because of the health effects of the pandemic, essentially the global economy was closed down. It was like placing a huge brake on the global economy when you force people to stay at home. And whilst placing that brake on the global economy, central banks continued to top up people's cash because we wanted to make sure that the economy didn't turn into a very sudden depression. So in the UK, the furlough scheme, all sorts of grants and loans. In the US, they just wrote helicopter money checks, literally gave checks to everybody in the US. And so you've got this huge break on the economy, this ever increasing demand or latent demand from money building in people's bank accounts generally. And then towards the end of last year, beginning of this year, huge reopening. And everybody, or a lot of people, want to rush out, make up for lost time, book holidays, start to go to the pub, restaurants, and so on. And yet the supply chain, which had ground to a halt over the previous 18 months, just couldn't respond to that sudden demand pressure. And we saw and expected inflation to rise. And central banks saw this as well. And they noted that it was more of a temporary factor and likely to be transitional. But as the inflation numbers continues to go up, more concern grew that maybe there might be an element of transition, but also an element of permanent inflation. And then just when really it was the worst time to add to that inflation burden, Russia invaded the Ukraine. And because Russia is a key exporter of oil and energy, and Ukraine's key exporter of foods, you disrupted, especially with all of the sanctions applied, disrupted the supply of these key goods and pushed inflation even higher. And it's led to now inflation in the UK around 10%, which is the highest level of inflation that we've seen for some time. And that's created an element of panic, significant concern and panic, especially in central banks, who are now looking to raise interest rates and have started to do so. Now, you'll see from this slide, though, that much as we've much as we've seen a ping up in inflation, because the points at which inflation had been high and low are very distinct and around key events in terms of economic lockdowns and then reopenings, this isn't a one-way ticket with inflation. We can see that it's going to have waves going forward. So much as we're hitting a peak wave at the moment, it's unlikely, and I've got a slide on it, that energy prices will double again over the next 12 months. And so actually the inflation being a measure of a rate of change, we expect inflation to come down. This will probably even create a sigh of relief for central banks, but that oscillation will then come back again and we'll have a secondary base effect and so on. Overall, though, what we expect to happen is that long-term 2%-ish inflation outcome that we've seen historically is likely to turn into a higher level of inflation going forward. And it's just an estimate on our part, but somewhere between 3 and 4% is where we see the average through this forward oscillation that I'm trying to describe on this slide. And what this does from a market point of view is that tailwind that I've described that we've seen for a long time effectively turns around now and becomes a headwind. Because if you're a business that needs capital, as capital gets cheaper and cheaper, that's very good for your business. But now that you're seeing capital become more expensive and the supply of capital is reducing because central banks aren't printing so much, then it becomes more tricky. And the market starts to, with a tailwind, we can imagine the market lifting all asset prices. With a headwind, markets will be much more selective about which assets are favoured and potentially rise in value and those that don't. And these headwinds really occur because of these factors. Inflation pushes interest rates higher. That also reduces money supply. We think the effect of the war in Ukraine is that we're redrawing with the announcements yesterday of NATO and 300,000 troops. This is all a rerun of what we've seen before in the first Cold War. The benefits of globalization are on pause and potentially reversing a little bit, and therefore market volatility has increased. This is very common when the future suddenly looks very different to the past. Markets are trying to adjust prices and expectations, and that creates volatility. And within that, some of the assets that did very well in the last cycle are falling, and in doing so will be creating volatility for other assets. But some will fall and not recover, others will fall and will recover. And clearly that's, we think, we're doing a good job of identifying those assets that really have the long-term value. To talk a bit about the assets that we think are falling and maybe won't recover, things like the crypto markets. I mean, Bitcoin's the one that you hear the most about, and that's fallen by about 2/3 from its peak. But there's been a whole family of these coins that developed post-Bitcoin, many of which have lost all of their value entirely and seem unlikely to recover. If we look at some stocks, these are good businesses, but they got very expensive. Tesla is always my favorite example, because when the valuation is nearly 100 times their earnings, you need huge amounts of growth in that business to effectively grow into that valuation, let alone providing the upside. And with all of the competition that you're seeing, congratulations for Tesla for building the electric vehicle market, but they're not going to be able to retain it for themselves because these other manufacturers are coming in very aggressively. And so when you're on those sorts of, when you need to grow the business that significantly for the share price to work, with all that competition, it becomes quite difficult. So we can see some asset prices that became quite fluffy and seem to have come down. But the broader sell-off in markets, we can see good signs of an overall recovery once the current volatility starts to subside. And that will really occur as we see this peak inflation begin to deteriorate. Just to give you some context around what's been happening, this graph is really showing markets since just a few days after actually Russia invaded the Ukraine, which was a big inflationary moment. And you see North America has been the hardest hit. So what did best from the tailwinds? It's probably struggling a bit more with the headwinds. We'd expect to see that. The UK market has been more resilient, which equally we would expect. There's a big old economy element to UK stocks. But the one that might surprise you is Asia's been much stronger. So Asia really has nearly been level as a market since the Ukraine invasion. Now, what's unusual about Asia is that they're not tightening monetary policy. Actually, they're loosening it. Their cycle is completely different to the Western cycle. So they're much more expansive in terms of their economic policies at the moment, and they're not suffering from the high levels of inflation that the West is. So we had seen Asia as likely to be a stronger market, and that in the first phase of this new cycle, we've certainly seen that in the prices. So I'll just touch a bit on the causes of inflation. And one of the key components is oil, because it's not just about the cost of energy directly. We all fill up our tanks and use energy in our houses and so on. But the cost of energy is also one of the key costs in every manufacturing business. So if you're seeing factory gate prices go up, part of that will be the cost of energy to the factory in producing whatever it is they're producing. But these days, the manufacturing process is very dependent on energy. And what we know about the oil price is it pings around probably more than you might expect. This goes back now to the beginning of the financial crisis, when oil fell rapidly as it became clear that the economy was going to slow down, the demand for energy fell, and so oil price dropped down to about $50 a barrel. At that point, China started to build infrastructure and work on a 5-year program and needed a lot of energy. And so the oil price rose dramatically up to about where it is at the moment. And because the oil price was so high for so long, for that 3 or 4 year period between 2011 and 2014, new supplies of oil really started to get traction. So the fracking industry had created technology that allowed oil to be extracted cheaper than it could have been before from deeper wells or wells that had previously been used and capped off. And so the supply of oil gradually grew, and China finished its 5-year program, didn't need so much energy. And we then had this period of a big oversupply of oil to about 2016. And then a lot of the frackers actually withdrew from the market, and there was a recovery and so on into COVID, a big fall in oil price, and then a recovery on the other side. That's all a very long-winded way of just saying that a high oil price inevitably leads to a low oil price. And that's because a high oil price gradually encourages much greater supply globally of oil. There's a lot of oil globally. There's very cheap oil to produce from the Middle East, particularly from Russia. And so even when the price is low, those countries export a lot of oil. But there's an awful lot of oil that can be extracted at $60, $70, $80 a barrel. And as the price rises, the entrepreneurs start to extract that oil and sell it at a profit. But as that supply comes on tap, generally, it leads to an oversupply at a later stage, and the oil price comes down. And if we look at the oil price now since about February this year, it's gone sideways. We had a rapid increase. So we've got more or less 4 months of no inflation now from the oil price. And if that persists for the next 8 months, then that pinging down of inflationary effects that I illustrated on the previous graph seems very likely to occur. So we've got our eye on the oil price, but this is a big factor in the inflation picture. And so far, since February, we've seen very limited further inflation from the oil price. To try and pull all of this together, really, in terms of where are interest rates likely to go. What's remarkable is if we look at interest rates from the major economies for the last 100+ years, they've been really quite consistent on average at about 4%. But we saw a bit above 4% in the early 1900s, and then a bit below. The shaded period represents the first Cold War. So as we saw deglobalization and lack of trust between the West and China and Russia, there were high levels of inflation, lots of other factors at work there, poor central bank policy as well. But we can see there was a big pendulum swing up in inflation, which is now reversed, and currently, up until just recently, we've had the lowest interest rates that we've ever seen. In this inflationary cycle that we're now seeing, which we think will come in 2 waves, the first that we're just at the top of, as I mentioned, a drop back down is quite likely, then a second wave up. We'd expect the cost of capital to top out somewhere around that long-term average of 3.5–4%. So 3 to 3.5% inflation expectation, 3.5 to 4% yields, and that'll probably occur over the next 5 to 10 years. That's a sort of length of time this cycle, the next cycle, will take to fully evolve and mature and restore really what we see as a long-term mean reversion. So you're bringing all those points into an outlook. One thing I haven't mentioned that I just thought would be worth talking about on this slide is there's a lot of speculation about a US recession, and we're likely to see a UK recession, but it won't be like any recession we've seen in terms of recent history, because inflation is always expressed in real terms. Economic growth is always expressed in real terms. So if economic growth in the UK was 1% and inflation was 10%, then it would mean that nominal growth, the actual growth in the economy, would be 11%, which would be a very high level of nominal growth. And inflation is at 10%. So even if we saw a recession where, for argument's sake, the UK economy shrunk by 2%, the actual nominal growth in pounds and pence would be 8%. So companies would be reporting pretty decent profit growth. Workers would be getting pretty decent wage settlements. We would be in a technical recession, but it wouldn't feel like it, because we would be going backwards in real terms, but in nominal terms, pound and pence, we would all be feeling wealthier. And so that's a very different recession to any that we've seen in living memory, because with those recessions, actually we've felt when we've had a recession, we've seen no growth in nominal terms as well as in real terms. So there could be a recession. It's not certain, it's quite likely, but if it is, it's likely to be more technical than real, and it will feel much better than it is because of this growth in nominal GDP, even though real is going backwards. So that's what I mentioned about the recession. In terms of this next cycle, we've got to be realistic in that, yes, there's been a good period with a nice tailwind, and returns have been good for all assets, even the ones that perhaps we'd question the quality. And longer-term returns for this next decade are likely to be lower. We've had a golden decade, and the types of annual returns we're expected to see will be lower, and with a high level of volatility. But it's still attractive, because as you go through inflationary periods, it's clear, looking back through data, going back a very long time, that good quality assets, albeit with greater volatility, is the most successful way to retain the spending power of savings, rather than cash returns, with yields being very low, and for some time, interest rates won't catch up with inflation. And therefore, the real return from cash has been falling quite rapidly, particularly over the last 12 months. Some of these overhyped assets, I mentioned Tesla and Bitcoin, and we've probably all got a little list in our minds. We might agree on some and not others, but there's clearly been some overvaluations in markets. I think US tech stocks, particularly the case. It's going to take some time, really, for markets to reevaluate what these assets are worth in the new cycle. And we're going to see continued volatility during that period. And as things like Bitcoin fall rapidly, they actually pull down the value of other assets, because if a lot of portfolios are rebalanced or are leveraged, either some borrowing within them. So a significant fall in the value of one asset in the portfolio often leads the manager to need to sell a little bit of the whole portfolio to recover that and rebalance it. And we've seen these periods before where a correction really in one part of the market leads to a temporary reduction in the value of other parts, but we do see those parts generally recover over what might be a 6 to 24-month period. And so within the assets that we're reviewing and the portfolios that we've got, that lean to quality assets, we think will see us through this volatile period and back to recovery in what will feel like a long period, but when we look back on it, will actually be quite a short period. Whereas those assets that fall and don't recover, those are where there's real danger of capital destruction and not areas that we're exposed to. So if I can hand back, Sam, to you, because I know you've got some questions and comments.
That's great. Yeah, thanks very much for that, Toby. It's been really really very helpful, actually. So I think a lot of the questions that were sort of sent in before the webinar have pretty much been answered by your presentation anyway. But there's a couple which you just could do with covering off now, actually, and they sort of feed into the themes you've been talking about. So the first one is about investing in Asia, actually, and could you just touch on what you think the long-term demographic drivers are for looking at the Asian region, which maybe don't appear in some of the sort of Western economies, which maybe people focus a lot of attention on, basically?
There's a few key points there. So I'll just repeat one from the presentation. So the West has been through a credit crisis and restructured the banks through essentially printing money, which is really a form of borrowing from the future. And Asia had its banking crisis in 1997, long recovered from it, and isn't facing the overhang of a financial crisis at this stage. And that's one of the reasons we think that Asia isn't generally suffering from the same inflation pressures that we're seeing in the West. We also think that Asia's got a much better demographic in terms of the age of its population and the size of its population and the growth of its population, because economic growth clearly has a strong link to the number of people you've got who are potentially able to work and consume and trade. And Asia not only has a big population already that's growing faster than Western populations, a lot of that population is still outside of having any economic impact. So people are gradually adopting Western standards of going to work, of consumption, and therefore that's a big driver for GDP growth. And although the US has had a great 10 years, if you look to the performance of Asia since about 2000 and the turn of this century, Asia's been a much stronger performer overall than even the US market. And we think when we think about things in longer term, which we do, the dynamic for Asia growth, with some additional risk, political risks, and I suppose counting standards and so on, but Asia's both at a low point in its cycle and quite well positioned going forward, especially given the weaker position of the West now that the interest rate cycle is turning back upwards.
Yeah, okay, that makes sense. Yeah, great, thank you very much. And we've just got another one here on going back to sort of interest rates. So what areas of the market do you think rising interest rates affect the most, basically?
Okay, it's what we call the high multiple stocks. So when you look at a company, one of the best ways to value it is, well, what's the profit it's making versus the share price? So if we look at a bank, for instance, we might find that the share price is 10 times the profit, which is a reasonably low multiple. And that's because the market's saying, well, we're fairly comfortable that this company's going to deliver a predictable profit, but it's not likely to grow it. And those sorts of businesses tend to be quite stable as interest rates rise. If I take the opposite, another example, that there might be a business now, like, well, I mentioned Tesla, but Netflix or let's say a pharmaceutical company that's developing a drug, it may have a price that's many, many times its earnings, but the market's expecting that drug to be signed off, get its patent, and then the earnings will increase rapidly. Now, as interest rates rise, those stocks tend to become vulnerable because they're usually reliant on high levels of borrowing. And as the cost of that debt rises, the pressure on their future earnings increases and the market tends to derate them. And what was actually one of the things I'm glad you've jogged my memory just to mention is that company earnings are still coming in quite nicely, and likely that's going to continue. They're just not going to necessarily meet inflation, but they're going to keep going up. So where markets are falling, it's not because the company earnings have generally been disappointing. It's because these multiples are reducing. And when you've got a high multiple, the downside can be quite violent as I think investors will have seen, whereas those low multiple types of stocks, you don't see the same thing. So really, it's more the techie growth hockey stick business plan type situations that suffer the most with interest rate increases, and those more stable old economy utility type companies tend to be just much more resilient.
And also, I suppose you'd probably throw sort of like very long dated bonds into that bracket as well, basically, where we have seen sort of some sort of pressure in this sort of fixed income market as well.
Of course, so the bonds are valued really on the current expectation of interest rates, and when you've got a bond where you're not going to get the money, the principal paid back for 30 or 40 years, if it's only yielding 1% because that's what the interest rate expectation was, and the market pushes up to 3%, then actually the value of that bond drops rapidly. And it's one of those things that's counterintuitive. People think of bonds as very safe, but actually in a rising interest rate environment, they can actually lose as much capital as some of the more wilder equities. And we have seen bonds drop quite significantly in value just over the last 3 months.
Okay, that's great. Yeah, and I think we've got time for just one more question. So someone was, I think we might have covered off, someone was asking about what the long-term impact of the Ukraine war is on changing government views or strategy, basically, which I think we've probably already covered.
Well, I think I've covered it. I will say it again. We think we don't see any. We think elements of this war are short term. The attrition on both sides militarily is so significant. Neither side can maintain a conflict at this level of attrition. So it's likely that this at some point will reduce down into some sort of a line between East and West Ukraine and fighting on that border, as both sides will reach a point where they need to retrain, rearm, reinforce for whatever the next stage of the military campaign is. And that period will give a lull, and that lull will be significant. It won't just be a few weeks, it will be months and possibly even years. So I said we think there's some room for what will feel like good news, or better news, I should say, in between Russia and Ukraine. But longer term, what we're seeing is this deglobalization. It's almost as if we're moving back to the 1970s and 80s, where there's serious mistrust now between the West and Russia, and an Iron Curtain is being redrawn. Defense spending has been hugely increased, and commitments to future defense expenditure the same. And the effects of that are inflationary. Globalization was disinflationary, which is why we could print so much money for so long without any real inflation issues. Now we're having to deal essentially with that hangover and see a world where trust is reduced, and therefore we'll see Russia pushed back behind an Iron Curtain, and that will take many years to resolve.
Yeah, so it's going to be very much almost like an onshoring of certain industries back into areas of like their own countries that they can then control, and whether that'll be seen better as a sort of domestic economy, sort of benefiting from that going forward potentially.
Well, I think you'll see much stronger cooperation within NATO, and NATO will trust other NATO members. So you might, things that are considered to be very, very important industries, like now energy, like steel, like weapons manufacturing. I think NATO will want to make sure that NATO members are covering all of those, that they're able to self-manufacture or provide those requirements without relying on states that they see at best as being unpredictable.
Yeah, good, excellent. Well, thank you very much for the presentation, Toby.
Yes, pleasure.
If anyone else has got any other questions which we haven't covered off today, then please do get in touch with your Clarion advisor or Clarion contact, and we'll be delighted to get back to you. But otherwise, enjoy the rest of the afternoon. Thank you very much.